In accounting, assets represent what a company owns, encompassing everything from cash and accounts, receivable to buildings and equipment. These are resources expected to provide future economic benefits. Think of it as everything the company can use to make money. They are listed on the balance sheet in order of liquidity, reflecting how easily they can be converted into cash. For example, cash is the most liquid asset. Understanding assets is crucial for assessing a company's financial health, as they indicate its ability to meet obligations and generate revenue. Proper management of assets is essential for maximizing profitability and ensuring long-term sustainability. Depreciating assets like machinery and equipment are also important to consider when evaluating a company's financial position. Now, let's shift our focus to equity. Equity, on the other hand, represents the owner's stake in the company. It's the residual value of assets after deducting liabilities. In simpler terms, it's what would be left if the company sold all its assets and paid off all its debts. Equity is often referred to as net worth. It reflects the investment made by the owners, plus any retained earnings accumulated over time. Equity can increase through profitable operations or additional investments by owners. Conversely, it can decrease through losses or distributions to owners. The basic accounting equation highlights the relationship between assets, liabilities, and equity. Assets equals liabilities plus equity. This equation underscores that a company's assets are financed by either liabilities, debt, or equity, owner's investment. So, the key difference lies in perspective. Assets are what the company owns, while equity is who owns the company. Assets provide the resources for operations, while equity represents the owner's claim on those resources. Another way to think about it is that assets are the tools, and equity is the ownership of those tools. Understanding both assets and equity is vital for investors, creditors, and management alike. Investors use this information to assess the company's value and potential for growth. Creditors use it to evaluate the company's ability to repay debts. Management uses it to make informed decisions about resource allocation and financial strategy. In summary, assets are the resources a company controls, while equity represents the owner's interest in those resources. Both are essential components of a company's financial structure and play a crucial role in assessing its overall financial health. Properly understanding and managing both is key to long-term success. Without assets, a company has nothing to work with. Without equity, there's no ownership or investment. They work together, hand in hand. One cannot exist without the other in a sustainable business. The balance sheet provides a snapshot of these elements. It shows the assets on one side and the liabilities and equity on the other. This visual representation helps stakeholders understand the company's financial standing. Analyzing these figures can reveal important trends and insights. For instance, a high level of equity compared to liabilities may indicate a financially stable company. Conversely, a low level of equity may suggest a higher risk of financial distress. Therefore, it's essential to consider both assets and equity in context. They are not isolated figures, but rather interconnected components of a larger financial picture. By understanding their relationship, you can gain a deeper understanding of a company's financial health and make more informed decisions. Whether you're an investor, creditor, or manager, this knowledge is invaluable. It empowers you to navigate the complexities of the business world and make sound financial judgments. Having explored assets, let's turn to equity. Equity, on the other hand, represents the owner's stake in the company. Think of it as their share of ownership. It's the residual interest in the assets after deducting liabilities. In simpler terms, it's what would be left if the company sold all its assets and paid off all its debts. This includes common stock, which is the initial investment by shareholders. It also includes retained earnings, which are the profits the company has accumulated over time and reinvested back into the business. Additionally, it encompasses additional paid-in capital, representing amounts received from investors above the par value of the stock. Equity reflects the net worth of the business and is a key indicator of its financial stability. A higher equity value generally signifies a stronger financial position. This indicates that the company has more assets relative to its liabilities. The fundamental accounting equation, assets equals liabilities plus equity, highlights the relationship between these components. It underscores that a company's assets are financed by either debt, liabilities, or equity, owner's investment. While assets show what a company possesses, equity reveals how much of those assets truly belong to the owners after accounting for all debts and obligations. Consider a house. The house itself is the asset. The mortgage is the liability. And your equity is the portion of the house you actually own. Now, let's delve deeper into how assets and equity differ in practice. Assets are used to generate revenue and fund operations. They are constantly changing as the company buys, sells, and uses them. Equity, on the other hand, represents a more long-term investment in the company. It's the foundation upon which the business is built. Changes in equity typically occur due to profits, losses, or additional investments by the owners. Understanding the distinction between assets and equity is crucial for assessing a company's financial health. Investors and analysts use these figures to evaluate the company's ability to meet its obligations and generate returns. A company with a strong asset base and healthy equity is generally considered to be in a good financial position. However, it's important to consider both assets and equity in conjunction with other financial metrics to get a complete picture. For instance, a company with a large asset base but also a significant amount of debt may not be as financially stable as it appears. Similarly, a company with high equity but low profitability may not be an attractive investment. Therefore, a thorough analysis of both assets and equity, along with other financial information, is essential for making informed decisions. In summary, assets are what a company owns, while equity is the owner's stake in those assets after deducting liabilities. Both are critical components of a company's financial position and provide valuable insights into its overall health and performance. By understanding the difference between assets and equity, you can gain a better understanding of how businesses operate and make sound financial judgments. This knowledge is invaluable for investors, managers, and anyone interested in the world of finance. So, keep exploring and learning about these fundamental accounting concepts. They are the building blocks of financial literacy, and they will serve you well in your journey to financial understanding. Remember, knowledge is power, especially when it comes to managing your money. And understanding assets and equity is a great place to start. Next, we will delve into the concept of liabilities.